All right, hello everyone. How's it going? So I'm Chris. This is my channel. I'm just going to document all of my reviews and valuations of companies. I've gone over a few, but I haven't actually told anyone yet how well, I have told how I do it, but and where I find my numbers, but I haven't given my general philosophy around investing. So I'm going to give that right now, and we're going to see how it goes. And for some reason, this is presentation is really struggling. Wow. Okay, all right. We're on investment philosophy. So I've gone over a few companies. I've gone over Google so far. Uber is my recent one, and then Arista Networks. Of those, I like Google the most. That's besides the point. I'm going to go over the type of companies that I look out for and the kind of qualities that I like to find in these companies. Um, so I'm going to go over my goal. Um, Ignore conclusion at the bottom. I'm not going to give a conclusion. I'll just say it myself. I'm going to go over my investment goal, the types of companies, the methods of analysis that I use when I buy and then when I sell. So my investment goal is one, to beat the annual returns of the market, the S&P 500. And while people say that's not achievable, it's very hard to do. Yeah, it's hard to do. However, I am of the belief that you can choose your own companies, if you do the research properly and you can beat the market. I'm truly of that belief. I've seen multiple people do it. Um, I'm actively studying on where to find these opportunities, and I think in the years coming, I will be able to kind of find my edge and my niche, and I will have the ability to sorry, there's a guy right there. Have the ability to beat the markets, not the markets, but the market at this rate. And again, if I don't beat the market, it's no big deal. Money is still growing. Because the types of companies I invest in, I don't ever believe will go rock bottom unless we see a world collapse. Two, I only invest in quality companies or companies with incredibly promising growth stories, or that they've shown potential. This is more the case with Uber and Arista Networks, is they show that potential, and that's what I look out for more, is the story behind it and the growth story, more the qualitative stuff than the actual numbers, because Uber was unprofitable for a while, but they did turn profitable. So there's that. My third objective, or my third investment goal, is to achieve a state in the portfolio where I have a passive income of about 5K a month, and that's far out. Um, because as of now, my portfolio is about 17,000, which is not nearly enough to make 5K off the dividends, especially with the company as I'm invested in now. So some of the companies that I do end up investing in the future to grow this passive income is going to have to change. I'm in some of the stuff, some things that I've been in for a while, about a year ago when I didn't know as much about investing and I didn't have a clear goal. I'm in riskier positions. However, they paid off. I think I got lucky mainly because of the bull run. However, uh, I'm looking to exit those soon and then probably put the capital into something um, more safe. And then fourth objective is to grow the portfolio indefinitely, or until it's necessary to liquidate it, which, hopefully never. Hopefully I can just live off of those passive income, because that's the goal, really. That's the goal of the portfolio, and what should be the goal of many people's portfolios if they start young, is to literally live off of the passive income. You have to do nothing. You don't even lift a finger, and you just generate money. So there's that. Moving on to the types of companies that I look for. Um, One, I'm looking for quality companies that are strong qualitatively and quantitatively, using fundamental analysis. So, if you're not familiar, shoot, my bad. If you're not familiar with the difference between fundamental and technical analysis, I'll give a short summary, but you should really go watch a video on that. Fundamental analysis is just using uh, the company's financials, the company's metrics, the company's qualities, and giving that a value. You're fundamentally looking at the fundamentals of the company, what makes them tick, what their margins are, all that kind of thing. Technical analysis is directly related to price action and the candlesticks and what's happening on the charts. And that's something that I don't necessarily look at all. However, I can see how it could be incorporated. I generally believe a lot of it is just blowing smoke up the ass. However, I might be completely wrong. I never know. But from what I've seen so far, I don't see how um, drawing lines on a chart is going to give you the value of a company, at least short term, or at least long term. So. there's that. Um, the difference between qualitative and quantitative analysis within fundamental analysis is that qualitative, again, is looking at the qualities of the company, its growth story, where it is positioned in the government, or if it has any political standing, those type of things. And then quantitatively, I have a friend who does that far better than me. Um, but he has a his whole sheet of balance sheets and financial statements, cash flows, finds the margins, finds the asset turnover rate, and then compares that with the previous years and then sees the growth there. That's something I need to work on. But quantitative is that kind of stuff, working with purely the financial numbers, which I do some of with evaluations and the other aspects I look at. But I'm mainly a qualitative person. So that was a long-winded first point. The second point is that I look for companies that are competitive and active, not just sitting around waiting to be overtaken. This is apparent with the, the companies that are competitors, the ones I invest to. So for Arista Networks, for example, Cisco is sitting around waiting to be overtaken. It's a fact. They're growing dividends, which is great. Every company should be growing dividends at this stage, at least in its life. But its revenues decreased or increased not at all. Net income is decreased or not increased at all. Cash flow is flat. Um, return on equity is flat. All these things are not growing, and they are uh, essentially waiting to get overtaken by Arista Networks, which is gaining more and more market share as we speak. So that's a compelling aspect of Arista that I like. Same with Google. People thought Google would just sit around and wait to be overtaken by ChatGPT or other LLMs. However, they went up to their I/O conference a few days ago, just absolutely crushed it with the new video model, and then showing that they are actively incorporating AI into Google search with queries, and they're not sitting around. In essence, there's a long way of saying they're not sitting around, just waiting to be taken over. Fucking air is in my eyes, holy. Anyways. The third company I look at, the third type of quality I look out for is that it's intrinsically trading lower than I think it should be. This is what I use on the valuations. Um, for again, this is going to be kind of rehashed. They contain a strong growth story. Five, they compound their growth, meaning they build off of what they've already built, which is a lot of infrastructure needs. Again, Arista is like more than I think about this, Arista is a great one. You should watch that video. I don't know if it's up, but it should be. Um, and then six, another aspect I look out for is if they're innovative tech. Um, is if they are innovative tech that they should be investing most of their cash flow, or they should be investing their cash instead of little to no dividend being with little to no dividend being paid out. Wow, I need to take a break because I am so long-winded right now. Anyways, they should be investing their cash with little to no dividend being paid out to us. The reason I like that, and even though I want this to be a dividend portfolio, currently right now I'm looking for the capital appreciation until I can move into those dividend paying companies like Microsoft, etc. Um, and the reason I like this in growth companies is because they are investing all of their earnings. As you can see with Amazon, Google, the cash flow some are investing has dramatically decreased, well, increased actually, but it's dramatically increased in this past year because of the AI infrastructure, which I think they should be doing. I think that's a good thing. So those are the qualities I look out for. And then seven is the hardest one to find, which is monopolistic traits. Um, think of Google and search. Like Google is basically synonymous with searching. Oh, Google it. Yeah, I'll Google it. You don't say I'll search for it or I'll Yahoo it. No, you say I'll Google it. Again, that's a threat that ChatGPT poses to them, so they've lost ground on that. However, they still have monopolistic traits. Um, the ones I don't look out for, the qualities that I tend to stay away from, are companies that tend to be valued too high, for that are unreasonable, even given their qualities and growth prospects. Two, I don't look for no moat in a competitive landscape. So again, if you think of Google, like the moat they have is search and all of the data that they've acquired over the years, that's their moat. They have an advantage there. I'm not going to be looking for a company that has no moat and no competitive footholding. You know, you could even think of like Lyft. Like Lyft just got obliterated by Uber. They have no moat and no competitive footholding. Three, I stay away from um, tech if they lack investment. So you can think of it like Cisco is kind of tech, but not really. Um, what would be one I can think of? I don't know. Really, every tech company should be reinvesting their earnings, but if they're not, and they're new, it's bad. It's not great because how are they going to get ahead with all these other companies spending billions, um, and investing cash flows and trying to get their products or whatever position higher? Four, I avoid meme stocks. Obviously, this is not going to be part of the valuations that I use. And then five, poor financials with signs of no future growth. Like you can think of Cisco, not poor financials, but no signs of future growth. So with the methods of analysis, again, I use only fundamental analysis. Um, and I'm trying to better my current understanding of the with a better understanding of the qualitative side, and I'm trying to improve my quantitative side. Um, so the stuff that I'd be looking at is like key financial metrics, ratios, growth estimates, historical performance, yields, competitive environment, industry standards, analyst predictions, and then horizontal analysis, which is more the quantitative side of looking on margins and how they're expanding or shrinking, I guess. I also look at bond prices. So when I say yields, that's what I mean. I look at bond yields and the risk-free rate is as a comparison and how risky investing in stocks should be. And then I also use that in the Graham valuation to model some stuff. Um, and then I also use multiple valuation models for each stock to price intrinsic value. And then again, I've gone over them, but they're the price to earnings multiples model, um, a Graham's growth model, and then price to book value per share model, and then the discounted earnings per share model. And I hope to add more in the future. Um, so that's all. So far, I'm off with these ones. Um, and then what I don't use is technical analysis, like I said before. I might look at moving averages, uh, in timing a buy, but really not that much at all, really. Now that I think about it, the only time I've ever even opened like TradingView or a charting platform was to look at return on equity over time because I couldn't find it anywhere else. So really, I can't think of any time I've used technical analysis in valuing my companies or finding good qualities about them. So I buy when price is below intrinsic value, or if the growth story is strong enough to justify its current valuation. And then I also apply a margin of safety of 15%. You could do 10 to 15. I do about 15%. That is after I value the price of the stock intrinsically. So if the stock is at $100 and then I apply 15% margin, it's going to be 85. So I'm just assuming it's 15% lower than what I actually calculated. Uh, that's a calculating for conservatism on my part because I could be wrong, definitely. And then the qualitative side is typically more important to me, which is why I can justify certain buys, even though ratios and valuations may be high. This is more apparent with like Uber, because I think the growth story with them is very promising. And however, they don't have the history of good financials to back it up, even though they are profitable now. Um, they didn't have it, but I think the growth story is there. And then last side, um, I sell when a company has a fundamental switch. Um, so this is hard to tell, especially over years. Um, but if there is and this could be a fundamental switch, typically caused from a business shock. So like, if I looked at Apple and Google, you could see Apple's revenue has barely increased over the past couple of years, if at all. Um, so that's definitely not promising. That shows me that they've kind of had a fundamental switch, and they are now, as you would say, a mature company, which is good, but not good for tech because you want to be innovating for tech. And there's a whole other reasons Apple's behind, like with AI. However, I'm not going to get into that right now because this is just about what I do. But that's a case of a fundamental switch. Over the past few years, you see the fundamentals change. Another one would be just a threat to the core business. So you could think of Google's. Like if Google had the next quarter, decrease of revenue, decrease of uh, yeah, decrease of revenue, decrease of earnings per share on the top and bottom line. that would definitely be concerning, because even though it's short term, uh, the threat of ChatGPT and other large language models could definitely pose a threat. And if we see that that actually does happen and it impacts the numbers, it would re I would reevaluate my Google valuation, definitely. And then I also sell when there's a better opportunity, simply put. So if there's a better opportunity and I want to allocate more capital over there, I have no problem selling out of a company. I'm not emotionally attached to them. Um, so I have no problem with do that. And then I never sell out of fear. So during the tariff debacle, um, I never sold anything. Well, I did sell one thing. I sold my VOO shares, because or a few of them, because I wanted to get more into individual stocks with the absolute discounts they were trading at. But I didn't sell any of my equities. I only sold VOO for a slight loss, but it offset some taxes. Anyways, yeah, I never sell out of fear. When that whole tariff thing was going on, I was buying that whole time. And then you can see, even just short term after that, the winners were the people that kept buying during that time. Um, and I think the Warren Buffett's approach is just the best. Is you have to be greedy when everyone's scared. I don't know what it's called, but I think it's be greedy when everyone's fearful. Be fearful when everyone's greedy. Um, so we're back at that kind of level. Since the start of 2025, where stuff has been a bit more greedy, but there's definitely still some discounts in the market. And with this whole tariff thing coming up, it's kind of like the whole market is dependent on the tariff decision that's going to be made by President Trump. Um, but I'm getting off topic. I kind of just ramble. So, anyways, that's been my philosophy. How what I look at. This is still very subject to change. I'm still very new to this. I'm about like a year to year and a half in. Um, so stuff can definitely change. And I am not opposed to any comments or questions or anything like that. And I'm an open book. So I'd like to see I like to see myself grow in this industry, and I'm gonna keep on working as hard as I can. So, see you next time. That's not what I meant to do. That is not what I meant to do.